Banks are gouging borrowers. Let's have a look. Hello everyone, Florian Heise here. Got my stein of coffee in hand and I thought we'd look at this article from the ABC discussing how banks are gouging borrowers or existing borrowers with their home loans. Now I don't think anyone at all would be surprised by this. We've all had, well, let's just bring up the cash rate guys to see the significant number of cash rate cuts. Those of us that have had mortgages, I mean, how many of you have rung up the bank to try and push them for a bit more, push them for a greater reduction? I know I have. Every time they, I say, guys, you get the money for free. You just print it out of thin air. Why aren't I getting a better discount? They look at me funny. They look at me funny, or they're on the phone strange. I remember when I went to the bank and I tried to buy gold or silver off them, and the manager said, "How old are you?" So let's have a look at this. Existing borrowers gouged by banks offering new mortgage discounts, the RBA says. Well, why can't we all borrow individually directly from the RBA? Wouldn't that be great? Wouldn't that be great if we all can have an account there and borrow at 0.75%? That'd be good. So, are you one of those people who spends hours online or in stores trying to find the best discount on the latest gadget or fashion item? Oh, I couldn't say I am. I guess I don't buy that much fashion items. Gadgets? Yeah, probably. Equipment. But then again, I found out with my 4K camera, afterwards I bought it, I could get it for half price directly from AliExpress, the exact same one, but those are the breaks. If the answer is yes, and you have a mortgage, then new data from the Reserve Bank shows you should probably divert some of that time to finding a better deal on your home loan. That is especially the case if your loan is more than 4 years old. Currently, these loans have an interest rate that is around 40 basis points higher than new loans, the RBA noted in its latest statement on monetary policy. On a $250,000 loan balance, that means an extra $1,000 a year of interest payments to the bank, potentially a lot more than you save on finding bigger discounts on anything else you bought this year. Well, yes, that's why, I make the challenge, the no spending challenge. Go a week without coffee and put every one of those $5 a day off your mortgage. Try that for a week, try that for a month, and just see what happens to your interest payments at the end of the month. See that little tiny dent down. Just keep chipping away at it, and it's probably time I hit the phones. Actually, I'll hit the phones. Try and get a better deal. And if you have purchased a home in Sydney or Melbourne over the past decade or so, there is a high chance your loan is a lot bigger than $250,000, and so are the costs of not shopping around with banks. As you might with retailers. Has anyone in Australia, has anyone had the capacity to actually borrow money from overseas, maybe from a European bank which is paying negative interest? Has anyone managed to do that? What if you took that and then paid it into one of these new micro banks to get 2.5% interest? It sounds like a potential for a lot of complexity and nightmares, doesn't it? But worth looking into. If your loan is twice as big, then the cost of paying the higher interest rate doubles, and so on. The situation is even more urgent if your loan was written more than 8 years ago and has not been refinanced since, with the RBA graph showing that on average, you would be paying around 60 basis points more than a new customer. Well, how hard is it to make a phone call? How hard is it to ring up the bank and say, I want a discount? Give me a better deal. It can't hurt. Can't do it. Worst case, you can go to a few banks. It's probably smarter to spread your savings and your debts around to a few banks. Because remember, with the all money clauses that these banks have, they can consolidate everything. Squeeze it all together. I've heard stories. People who had all their home loans, mortgages, business credit cards with the banks. And this is shared to me by a mortgage broker. This one gentleman had a successful business servicing the airport industry with regards to the trolley collection. And what happened was, after 9/11, the banks wanted to reduce their risk. So they told this person, you need to pay off all your credit cards, all your mortgages. We don't want you as a customer anymore. He had a month to do it. So this broker managed to find him another bank that would transfer everything over and take that risk on. A couple of years later, the bank rang him up and said, oh, we want you back. We'll pay you a good discount. We'll give you a good deal. So he went back. How stupid is that? When they've completely screwed you over. And this is what the banks can do. This is why. Think about it. Why, when they can arbitrarily make changes to your home loan. It's not a contract. It's not a negotiation. They'll just say this has changed. You can't do that with other contracts. If you were working for someone, if you had a contract with a client, could they just arbitrarily make changes without your input? It's not how it works, is it? These are the banks. Different world. So outstanding variable home loan rates. So 8 years, I mean, there you go. 5%. 5%. You want to be below here. Below here, below 3.5%. There's even some lower. Some below 3%. While the Reserve Bank said some of the discrepancy could be explained by a shift in lending from riskier and more expensive interest-only loans to safer and lower-rate principal and interest loans over the past few years, it noted that the interest rates on new principal and interest loans were still a lot lower than their older counterparts. This reflects the tendency of competitive pressures to be strongest for new and other borrowers who are in the process of shopping around for a loan, observed the RBA. So huge discounts are available from some or for some borrowers. These competitive pressures appear to have intensified over recent years, with banks offering substantially bigger discounts on what are known as standard variable rates, or SVRs. The SVR is the interest rate you may see banks and media outlets referring to when they are discussing whether a rate cut or rise has been passed on to consumers, or to customers as they call them. But virtually no one is on the SVR. If you are, you're almost certainly heavily overpaying for your home loan. The average discount on the SVR being offered to new borrowers with the major banks has risen from around 100 basis points just 5 years ago to well over 150 basis points last year. So here you go, the new discount. The Reserve Bank noted that the very cheapest home loan advertised may be around 200 basis points, that is a full 2 percentage points below the standard variable mortgage rate. That is basically 8 official rate cuts, difference between paying the bank's racked rate, to borrow some hotel jargon, and the cheapest discount rate. So, are we heading there, guys? Are you getting that deal? While SVRs are the reference rate against which variable loan rates are priced, lenders also advertise a range of interest rates that are materially lower than the SVRs, the RBA advised. In addition, most individual borrowers are offered or may be able to negotiate further discounts on the interest rate applied to their loan. For instance, the major banks package mortgage interest rates for owner-occupier loans currently attract a discount of around 50 to 100 basis points on SVRs. The lowest advertised rates are around 100 basis points lower than these package rates, and a few borrowers receiving larger discounts. These figures come from new data from the RBA, bank regulator APRA, and the Australian Bureau of Statistics have started publishing this year. The data is intended to help consumers understand the interest rates that are actually being charged in the market. It may pay handsomely to keep an eye on them even now, and then to make sure that your home loan has not fallen out of line with the best rates currently available. Well, yes, no, definitely. That's some very good advice. You should be making a phone call, I'd say, every 6 months, if not every quarter. Particularly now with all the rate cuts that are happening. You know? What effort is it to go to another bank, get a counter deal, put it on the table, go match it, beat it? Beat it. Can't hurt. Saves you money in the long run. They're going to make a ton of money off you anyway, guys. It doesn't cost them anything. Just keep that in mind. Let me know your thoughts and opinions in the comments below, guys. Oh, there you go. There's Australia's education level. Press the wrong button. Thank you for watching. Please like, share, and subscribe. If you're a fan of the channel and want to help that little bit extra, we have a few ways you can support us. There's a Patreon where you can join and make a monthly donation. We also have the ability for you to join the channel here on YouTube, where you get access to badges and emojis. We have affiliate links with Amazon, eBay, and Independent Reserve We sell pocket squares from the HeiseSays website, and PayPal if you want to contribute that way. Thanks to everyone who's helping the channel. Take care, guys, and I will see you all in the next video. Bye for now.